Okay, welcome to this explainer. Today we're diving straight into a highly specific, totally anonymous expert report dissecting the structural realities of citizenship-based taxation. Now, we aren't here for surface-level storytelling or generic financial advice. So we're going to strictly analyze the core mechanisms, the implicit assumptions, and the severe cause and effect relationships that govern individuals living abroad who suddenly find themselves caught in this unique jurisdictional net. We're looking at a system that claims tax jurisdiction not based on your actual economic footprint, but literally on the biological event of your birth. If you want actionable insights and the non-obvious details regarding global tax exposure, you are absolutely in the right place. Okay, let's dive into this highly technical analysis. We've got a rigorous structural framework today. First, we'll look at the citizenship taxation mechanism. Second, the scope of global tax liability. Third, mechanisms mitigating double taxation. Fourth, the structural limits of tax treaties. And finally, we'll evaluate the ultimate exit strategy. Section 1, the citizenship taxation mechanism. So let's start with the foundational architecture of this whole framework. Unlike almost every other tax system on the globe, this mechanism operates on a very specific, totally inflexible legal standard. The expert analysis defines a highly specific cohort caught in this web, the accidental citizen. Basically, this is someone who acquired citizenship just by being born on sovereign soil, but who then departed, maybe as a tiny infant, and has zero subsequent geographic or economic ties to that nation. The implicit assumption built into the law here is just staggering. It assumes that the mere event of your birth confers a lifetime of active, perpetual participation in their tax system. It creates this massive, profound disconnect between the rigid legal code and the reality of a person's actual economic life. Which brings us to a really fundamental question. It might challenge common sense, but it's absolutely vital for understanding this structural reality. Does a lack of geographic residency, or even just having zero intent to ever return, eliminate your tax reporting obligations? The analytical answer? An absolute definitive no. Literally, ignoring the law doesn't make the liability magically disappear. As the expert report details, if that global citizenship status is maintained, then worldwide income reporting is strictly compulsory. The system honestly doesn't care if you've lived in a foreign country for 40 years, or if every single penny you make is sourced entirely outside the issuing nation. The reporting requirement is tethered rigidly to the status of your citizenship, not the coordinates of your physical location. So you end up with this perpetual liability, even if you haven't used a single public service, driven on a single road, or benefited from any infrastructure of that nation since you were a baby. Moving on to Section 2, Scope of Global Tax Liability. Now, what's really interesting about this slide is the sheer, inescapable breadth of the net being cast. This isn't just about paying some tiny marginal surcharge. The structural reality is that it nets all income universally. First off, you've got taxation on worldwide income, regardless of the source. Local pensions, a foreign rental property, your wages, it all has to be cataloged and reported. Second, and this is a severe, non-obvious detail that catches so many people completely off guard, the potential liability for global employment and self-employment taxes. Say you're an independent contractor in a foreign jurisdiction. The issuing nation might still demand self-employment taxes from you, unless there's a highly specific, bilaterally negotiated totalization agreement between the two countries. You're looking at an immediate, unmitigated scenario of absolute double taxation on the exact same earnings. And finally, there's the administrative nightmare, the mandatory annual filing of incredibly comprehensive tax forms that carry massive financial penalties if you mess them up. Section 3, Mechanisms Mitigating Double Taxation. Because this system inherently creates that immediate threat of double taxation, literally being taxed simultaneously by where you live and where you hold citizenship, highly structured frameworks have been designed to legally mitigate the overlap. The expert analysis cleanly delineates the two primary tools here side by side. On the left, the foreign earned income exclusion. This mechanism actually excludes a specific amount of your foreign earned wages from taxation, but only, and this is a big only, if you meet incredibly strict physical presence or bona fide residency tests. The structural friction here is huge. The system just implicitly assumes you have the sophisticated administrative resources to formally prove your residency to a distant foreign tax authority. Then on the right, we have the foreign tax credit. This one doesn't exclude your income. Instead, it provides a dollar-for-dollar credit for actual compulsory income taxes you've already paid to a foreign government, applied strictly against your overall liability. But it's absolutely crucial to analyze the boundaries of these frameworks because they aren't unlimited fail-safes. The exclusion mechanism, for instance, is strictly capped and indexed annually for inflation. Based on the data analyzed for the 2024 fiscal year, the absolute ceiling for this exclusion is exactly $126,500. So what structurally happens if you earn exactly $126,501 while living in a jurisdiction with a lower local tax rate? Well, that single marginal dollar immediately pierces the protective exclusion and triggers a direct active tax liability to the issuing nation. It forcefully tethers your local grounded success to a foreign jurisdiction's tax matrix. And this brilliantly illustrates just how complex the alternative mechanism, the foreign tax credit, actually is. You don't just automatically get a credit simply because you sent money to a foreign government. No way. You have to pass a rigorous, four-tiered legal test. Step 1, the tax must be formally imposed on you, the taxpayer. Step 2, it must actually be paid or formally accrued. Step 3, and honestly, this is a massive trap for the unwary. It must be computed strictly at the legal or treaty rate, not a penny more. And step 4, the foreign levy must legally qualify as an actual income tax. To give you a clinical example, let's say you make mandatory payments into a foreign socialized system that gives you direct benefits, like national health care or a guaranteed pension. Well, those are often analytically rejected by the issuing nation as creditable income taxes, which leaves you fully exposed. Section 4, Structural Limits of Tax Treaties. That third tier seamlessly brings us to our next structural element. A lot of lay people implicitly assume that tax treaties are absolute shields against double taxation, but the expert report reveals they structurally possess massive limitations for citizens. The most non-obvious and downright dangerous detail here is the existence of saving clauses embedded inside these bilateral agreements. A saving clause basically says the home country reserves the absolute right to tax its citizens exactly as if the treaty didn't even exist. So, these saving clauses actively prevent citizens from utilizing the treaty to claim non-resident status and escape the reporting net. On top of that, any tax reductions or credits you try to claim only apply to the legally compelled treaty rate. If a foreign country over-withholds your taxes, you are structurally required to exhaust all practical foreign administrative remedies to get those funds back before you can even think about claiming a credit. So the crucial point is this. The analytical conclusion is pretty stark. Let's say a treaty dictates a 15% tax rate on dividends, but the foreign country mistakenly withholds 20%. Well, that extra 5%, it's literally classified as dead money in the eyes of the home country. You can't just claim it as a foreign tax credit. The report dictates you actually have to invoke formal competent authority procedures or file amended returns in the foreign country to claw back that excess. And crucially, the systemic inefficiency here is devastating. The financial costs of hiring specialized cross-border tax attorneys to legally pursue that refund often drastically exceeds the actual monetary value of the 5% over-withheld tax in the first place. It creates a structural dead end that puts the entire financial and legal burden squarely on your shoulders. Let's move to and see how this builds into Section 5, the ultimate exit strategy. When you're faced with the perpetual friction of worldwide reporting, the invalidation of treaties through saving clauses, and the massive administrative overhead of exhausting all those foreign remedies, we arrive at the final conclusion of the expert report. The assessment is entirely clinical. It states,
Quote, to alleviate the perpetual loop of worldwide reporting and potential double taxation, the ultimate structural remedy is the formal renunciation of citizenship. It's a stark, absolute legal maneuver. But listen, formal renunciation is not just tossing your passport into a desk drawer. You have to navigate incredibly complex, punitive exit tax regimes, legally prove 5 continuous years of rigorous prior tax compliance, and pay significant administrative processing fees. It effectively acts as a final, inescapable toll charge just to officially exit the system. Yet, mathematically speaking, it represents the only guaranteed method to permanently sever the jurisdiction's ongoing claim to your global economic activity. Which leaves us with a profound structural dilemma to analyze. For anyone holding this status, a highly calculated cost-benefit analysis is completely unavoidable. You are essentially forced to ask yourself, does the perpetual administrative, legal, and financial burden of maintaining a dormant citizenship truly outweigh the absolute, irreversible finality of structural renunciation? It is a really heavy question regarding the true perpetual cost of accidental citizenship, and one that demands serious analytical reflection. Thank you for joining me in this explainer. Until next time, keep analyzing the structures behind the rules.